50% of people watching this video think the stock market is rigged. Or at least that's what a recent study by Bankrate seems to suggest. Is the stock market rigged? Well, yeah, it probably is. So what's the point in even investing? In this video, we're going to look at the reasons why the stock market is in fact rigged against us. And after I've crushed your resolve and stomped on any dreams you had of a better life, I'm going to pick you up, dust you off, and show you why everything will be just fine. Let's go.
The stock market's rigged. The United States stock market, the most iconic market in global capitalism, is rigged.
People have made a lot of money by, in effect, taking advantage technologically of a system.
And how they have a monumental advantage over the regular trader, meaning
proof that the stock market is rigged.
We're such suckers.
Restricting trading on some names.
We're such suckers.
Before we start, we need to define what it means to be rigged. The etymology of the word rigged is actually really interesting. Well, at least I think it is. If you don't think it's interesting and can't be bothered listening to this, timestamps below so you can skip it. In the context of it relating to a scam, there is evidence that the word first came about in the 1600s, but it didn't appear in dictionaries and books until the 18th century, when it became popular to study what was called rogue literature. Basically, the posh suddenly wanted to know what all of the weird words were that all the thieves and crooks were saying and what they meant. Think of it as like an 18th century urban dictionary. One such book was called Francis Grouse's A Dictionary of the Vulgar Tongue, in which he describes rig as fun, game, diversion or trick. But it wasn't until the early 19th century that the word rig moved out of the mouths of thieves and became a term used to describe fraudulent auctions
minus another £105
and a particular stock scheme where brokers would corner the market for their own benefit. Language is a beautiful thing. A word made up by thieves to describe their hustle became a label for corrupt bankers a couple hundred years ago, and fast forward to today and it's still being used in the same way now. They knew it then and we knew it now. While the strict meaning of rigged has ebbed and flowed, it has shared one characteristic throughout its history, and that is the concept of an unfair game, where one party has an unfair advantage over the others. And if you're asking for examples of unfair games in modern day investing, well, you're in luck.
Here's one I made earlier.
As a retail investor on your side of the fence, I'm probably not aware of all the ways that I'm being bent over by institutions. But here's just a couple of examples of unfair advantages the system has over us, starting with,
this is the story of time.
We can all agree that time is valuable, but how valuable? How much value would you place on time? If I could give you an extra 10 years of being in your 20s, or how about an extra 6 months of hot weather this summer? Or even just a couple of extra weeks on holiday without it affecting your job? One extra day each weekend? Or how about an extra hour in bed each morning? How much value would you place on that time? How much money would you give me for 5 milliseconds? That's about 20 times faster than a human eye can blink if you're really trying. Nailed it. Well, that is exactly what Dan Spivey's company Spread Networks attempted to do after spending 300 million quid building an 827-mile high-speed connection between the Chicago and New York stock exchanges. This new connection cut down the time it took for information to travel between the 2 points from 17 to 13 milliseconds. The cost of entry or admission to this high-speed line was millions up front and $300,000 a month, making my BT fibre look like an absolute bargain. Millions of dollars for a fraction of a second. This is the price high-frequency trading firms will pay for speed, but why?
Michael Lewis has got a new book out about the stock market. Oh boy, it ain't pretty. He's going to go on 60 Minutes to talk about it. It's called Flash Boys.
That's the guy who wrote The Big Short, and in the book he outlines his theories on why individuals are willing to pay so much money for such small amounts of time, and how people who don't do this are being screwed. Michael says it's so that these companies can engage in something called front running, which is an illegal practice.
You don't understand. They're able to front run your order.
What do you mean front run?
He basically says that these high-frequency trading firms are using speed as an unfair advantage to strip fractions of a penny from investors millions of times a day for profit. I want to caveat this by saying that Michael is in the business of selling books, so he's always going to lean more towards the scandal and, amp things up if he can. Front running is illegal as it's considered insider trading, which we'll discuss in a minute. The high-frequency traders would argue that they're not insider trading because the information is available to everyone on the market. They can just react to it quicker than anyone else. The key thing is, the stock market isn't a place. It's a network of exchanges that all communicate with each other. If you can be quick around that network than everyone else, then you can profit. One such company that engages in high-frequency trading is Citadel.
For me, the thing that distinguishes Citadel from other firms in a word would be relentless.
This is the company that was dragged in front of Congress to answer questions around GameStop.
Thank you for the opportunity to testify today on the recent market events.
and its involvement in the blocking of people's ability to trade it via apps like Robinhood in America.
Said there are, frankly, as you know, a lot of angry customers out there and a lot of questions about what took place and the decisions that you made to limit so many of your customers' ability to buy stocks like GameStop.
Basically, a part of Citadel was one of the companies that was short in GameStop, so they were losing a lot of money as part of the short squeeze that was going on when everyone was piling in. Now, the argument is that Citadel used their influence over Robinhood to put the brakes on people's ability to be able to buy GameStop, to relinquish that pain on their side. The reason they have this influence over Robinhood is because they purchase Robinhood's order flow. Robinhood can provide free services to customers because it directs the orders to Citadel and is paid for it.
When you're not paying for it, it's not free. You're the product, someone else is the customer.
The type of revenue called payment for order flow makes up 81% of Robinhood's revenue. So you can understand why people think that Robinhood really have to answer to these companies, because they make up like 80% of the money that Robinhood makes. Now, the argument is that Citadel uses this information for high frequency trading because they can literally see what people want to buy. Payment for order flow is actually not allowed in the UK, with the FCA stating as follows: these payments can create a conflict of interest between the firm and its clients. This is because they incentivize the firm to execute its clients' orders with counterparties based on their willingness to pay commissions. The FCA's got your back, guys. The Mars bars are on them. So that is theory one of how the stock market is rigged. High frequency traders and conflicts of interest leading to unfair advantages and front running. The next one's a little bit more simple.
What exactly is insider trading?
Insider trading is the act of using information that isn't available to everyone else for the purposes of benefiting from the stock market. It was banned in the Securities Exchange Act of 1934, but since then, people have been getting busted for it on the regular.
The overall case, by far, is probably the biggest insider trading prosecution ever.
I mean, how are you going to stop people from gossiping? But the concerning thing here is, though, on December 11th, 2014, the United States Court of Appeal gave an early Christmas present to the 1%. It basically meant that the government could only prosecute people for insider trading if they could prove that that individual knew the original source of the information and that that information had been released for improper use. So basically, ignorance is bliss here, guys. You could just claim you don't know where that information came from and that you weren't aware that it was insider information. If you're playing golf with your billionaire buddies and one of them gives you a tip his broker got from a drinking buddy at another firm, you can act on it. And as long as you don't know the original source and you play dumb, that isn't insider trading. This is Senator Richard Burr. Hello, Richard. And in 2020, he was called to a secret government meeting to discuss the emergence of a new virus that was about to kick the world's butt. He came out of that meeting and sold his shares.
Had a behind closed doors meeting about the coronavirus in China and what it could mean to the United States and, you know, the various impacts. And they went out and sold their stock.
Immediately.
Dude. And then, but at the same time, they were talking about how under control the government had it.
Kelly Loeffler and her husband Jeffrey Sprecher, who just so happens to be the chairman of the New York Stock Exchange, also sold loads of shares after the meeting and bought into companies that were set to benefit from the pandemic. How can the chairman of the New York Stock Exchange plead ignorance when it comes to using information that he's got from a secret government meeting in order to benefit from the stock market? Footballers can't even bet on Sunday league games, but these guys can use information they've got from secret government meetings to profit from the stock market. Seems fair, doesn't it? Speaking of the government, another way that the stock market could be described as rigged is via government intervention.
And so tonight, I'd like to talk to you about our way forward.
I got a riddle for you. How, when the world is in the throes of one of the worst economic events in living memory, can the stock market rise? One explanation for this could be quantitative easing, a posh way of saying creating cash out of nowhere to pump into the system. We all know that governments around the world have printed a load of cash, and that cash then ends up back in the markets, inflating the prices of assets. So that means that governments can influence the price of the stock market through interest rates and quantitative easing. Now, we may have all benefited from that as investors over the last few months to a year, but what happens if we're buying assets at inflated high prices, they pull away the quantitative easing, and we're left holding the bag? According to a study by the Federal Reserve themselves, they don't even need to spend money to push the prices of stocks higher. Just holding one of their FOMC meetings is enough. FOMC, or Federal Open Market Committee, is the body who decides on American monetary policy. Even if they just get into a room together, then the markets get excited and rise. Right, on a scale of 1 to 10, how depressed are we all feeling? So if you stop watching the video here, you're going to think that high frequency traders with rapid broadband and the 1%ers are all screwing us to the floor with their unfair advantages, and investing is pointless because you can't compete. Now it's time for a little bit of positivity and for me to discuss why I don't think really it's all that much of a problem at all. As we did with the negative section of this video, let's start with front running. It's called front running because in the days when stock orders were literally placed by people, someone would walk across the trading floor with an order in their hand. A shady broker could then leg it in front of them or front run them and place an order for the same share that they were going to buy. As technology has improved, the concept stays the same. Speed is and will always be an asset in trading, but rather than fastest across the trading floor, it is now going down to nanoseconds. But the reality of it is, and what Michael is often criticised for not mentioning in his book, is that the pennies these HFT firms are shaving off the stock market don't really impact us normal investors at all. Especially if you're a long-term investor and you're not dipping in and out of trades consistently on a daily basis. First of all, the trades of retail investors like us are not their target. The HFT firms actually target other banks like Morgan Stanley. And let's say you're looking at an investment and at £100 that investment is good for you, but £100 and a penny, you're like, that's too expensive, I don't want to buy it. I think that you're probably looking at the wrong types of investments. Yes, it's annoying that the guys and girls with resources are quicker and can benefit, but that's the way of the world. Sitting here sweating in my pants, it's unrealistic for me to expect to have the same level of insight, information and speed as these companies that spend literally millions on talent, resources and infrastructure. It's like saying a pub football team should be able to win the Premier League just because they play the same game. In reality, we ain't playing the same game. But the risk here is that in an effort to stick it to the system and beat the man, investors now appear to be taking more and more risks. GameStop and AMC are an attempt to stick it to the man by buying companies in the hope of a short squeeze.
The sainted stocks of AMC and GameStop to the mobs who are determined to take it higher. They want them higher.
Now, while the cause is noble, and even I've stuck a little bit of money in just to show support for the cause, we have to admit to ourselves as investors that this strategy is more risky. All I'm saying is that the idea of revolution when investing in the stock market is a dangerous game to play. Maureen O'Hara said in her book, although markets have always been an inhospitable environment, a little bit like this loft, by almost every measure, American equities are more transparent, cheaper to trade in, and better policed than ever before. Imagine trying to invest in the stock market back in the day when it was more like crypto. All of the things that are happening in crypto at the minute, like rug pulls and Ponzi schemes and pump and dumps, none of that's new. It's all taken from the stock market, how to scam people playbook from the past. Regulation tends to be reactive. It often has to play catch up with the people that abuse the rules. And it's naive to think that people in power aren't going to use that power to make themselves a load of cash if they can. This is why I hold index funds long term as the majority of my investments and don't day trade. Because I know there's some serious competition on the other side of that screen. Who are you going to bet on? Damo sat in his boiling hot loft in his pants, or a room full of Harvard graduates trained by Goldman Sachs with Bloomberg terminals? I'll give you a bit of an insider tip, don't bet on me. Yes, the big players in the market use unfair advantages to fleece us in ways that we probably don't even understand, but show me an industry on this planet that isn't the same. Train stations often charge 20p just to use the toilet, because they know I'll be desperate coming off that carriage because there's no chance of ever getting to the actual toilet in carriage E through that crowded train. They're literally front running my need to pee all the way to the bank. And don't even get me started on casinos. They're literally rigged so the house wins, but millions of Britons still continue to use them year on year. It's a well-known fact that the longer you stay in a casino, the more chance you have of losing. The way to win in gambling is when you win, you get out. But the stock market is the complete opposite. On any given day, you've got about a 50% chance of winning or losing if you invest in the stock market. But the longer you stay at the seat, the longer you stay invested, the better your chances get. One study showed that if you invested for over 13 years, you're pretty much guaranteed to win. So pull up a seat, get comfy, we're in it for the long term. The people at the top in power will use that power to their advantage. That is essentially a fact of life. But don't be dismayed and sit there thinking, why should I even invest? It's pointless. Or follow high-risk strategies in an attempt to stick it to the man because you think that's the only way to win. In my opinion, everyone should invest, even if it is rigged, because what rigged game anywhere else in the world has returned an average of 8 to 10% for the last 100 years for plebs like us?
Mother